Hello everyone, welcome to the webcast of Expected Credit Loss. I am Keyur Dave, partner and leader accounting advisory at BDO India LLP. This webcast is about understanding the expected credit loss model, its implication, its scope and measurement. In a simple term, if I need to define what is expected credit loss, it is nothing but the difference between contractual cash flows due to the entity and the cash flows entity expect it to receive. Generally, you can see that provisioning of the loss is coming in each and every entity's financial statement, given that there is a contractual due or recovery of entity from another entity in a business model. However, one may see that the expected credit loss impact will be far higher in terms of entities such as banks and NBFCs. The expected credit loss model applies to the financial asset such as trade receivables, loan to group companies, intercorporate deposits, financial guarantees, loan commitments, lease receivables, etc. New impairment model is based on three-stage model, and this three-stage model works based on significant increase in the credit risk since its initial recognition. Let's understand all these three stages. Stage 1, which is also referred as performing asset. Here an entity needs to recognize interest on the gross carrying amount. However, it needs to recognize the expected loss based on 12-month expected losses. What do we mean by 12-month expected credit losses? It is nothing but a representative of a lifetime expected credit losses that are expected to arise based on default, which is going to occur in the possible next 12 months. Coming back to stage 2 is nothing but an underperforming asset. In this stage also, entity needs to recognize interest based on gross carrying amount, but instead of 12-month expected losses, now entity needs to recognize lifetime expected losses. And what is lifetime expected losses? It is nothing but the all possible events of default which gonna occur during the expected tenure of an instrument. Stage 3 is akin to a non-performing asset or a credit impaired asset. Here entity needs to recognize interest on a net carrying amount. Net carrying amount is nothing but the gross carrying amount minus the loss allowances. We need to make a point very clear that at every reporting date, if there is a low credit risk, then one can assume that there is no significant increase in the credit risk and entity can still continue to apply 12-month expected losses. It is very important for an entity to understand the determination of significant increase in the credit risk. When an entity understands that there are indicators which defines that there is an increase in the credit risk, the indicators defined by the standards are such as changes in the economic or the local market condition, changes in the financial results of a borrower, changes in the financial support from the parent, expected delay in the payment, or expected or probable default of the covenants. Please note that the word is expected delay in payment or expected or probable default in covenants. It's not actual. This is a significant move because we move from incurred loss model to an expected loss model. So entity needs to determine when there is a future probable expectation that the borrower will default. New expected loss model is a forward-looking model. Entity needs to determine its historical losses and also need to estimate the forward-looking statement. Does that mean that entity needs to see all the future conditions? The answer is truly depending on the available information. Entity does not need to expect all the future conditions of the instrument. However, from the available information and all the detailed information which they can extract from the data source, that will be really helpful to determine the expected loss model. Standard also speaks about extrapolating the information from the data source, which includes information such as internal rating, internal experience of the historical losses, external rating, or expected loss accounted by peer group companies. Let's take an example to understand the movement between two stages and measurement of the expected losses. Say bank XYZ is giving a loan to a borrower and accepting his real estate as a collateral. Now, next reporting date, bank has analyzed that there is a downturn in the local economy and there is a significant increase in the credit risk of the borrower. This makes a clear indication that the borrower has moved from stage 1 to stage 2. Hence, bank needs to account the 12-month expected losses moving to lifetime expected losses. However, when you measure the expected losses, you need to consider the collateral value as well. Now, since real estate value is on a higher side, there will not be any actual loss in the books of the bank. So one need to understand that the determination of stages is actually not linked with the actual losses. There is also one point which I would like to make here, that when an entity is doing an acquisition under business combination, the initial recognition of the credit losses start from the date of business combination and not from the original date of the acquisition of the financial asset. It is important to note that standard does not prescribe any particular method for the measurement of expected credit loss method. Measurement may vary depending on entities to entities based on type of instrument, available information, or the scale of business. Hence, measurement of ECL may not be comparable between two entities. However, standard defines 3 basic parameters which one need to consider while calculating the measurement expected losses. First one is unbiased probable output, which means an entity needs to evaluate range of possible output to evaluate measurement of the expected losses. The second point is present value. Entity need to understand to find out the present value of the future expected losses by discounting with appropriate discounting rate, which may be an effective interest rate or similar rate. The third point is cash shortfall. Cash shortfall is nothing but all the contractual cash flows due to the entity and entity expected to receive from the borrower. It is also imperative for an entity to assess when to measure expected losses and which product needs to be bucketed together. I'm talking about segmenting of your financial asset. If there are large corporate exposure or there are credit impaired financial asset, generally they need to be measured individually. However, if there are retail exposures or exposure where less specific information about borrower is available, it's preferred approach to put them in a bucket together. Now, when you make this segment, it is important to understand the shared credit risk characteristic such as customer rating, customer type, collateral quality, product, industry, geographic locations, or term to the maturity. Standard also gives one of the exemptions where you can apply simplified approach for trade receivables where there are no significant financing component. Rather than moving from stage 1 to stage 2, simplified approach directly provides trade receivable to be accounted under expected loss model based on lifetime expected losses. Given the fact or a scenario that since there is no significant financing component, the tenure of such instrument should be less than 12 months. However, for a long-term receivables or a lease receivables, where there are significant financing component, standard provides an accounting policy choice, whether to apply a general 3-stage approach or to directly move to a lifetime expected losses. Entity needs to decide this policy choice and apply it consistently. Expected credit loss models scope extend to off-balance sheet item as well, such as loan commitment and a financial guarantee. Loan commitment is nothing but a commitment provided by an entity to provide a loan to another entity on a future date. If there is no significant increase in the credit risk, then entity needs to understand that they have to apply 12-month expected losses. But it is important to understand that the expected credit loss will be applied on the expected drawn down from the another entity on the loan commitment. If there is a significant increase in the credit risk, entity needs to go to stage 2 and apply lifetime expected losses, which is the expected drawdown by the borrower over the entire expected life of the instrument. The measurement of loan commitment is nothing but a contractual cash flows that are expected to be drawn down by the borrower and the expected cash flows which entity believes it will recover from that borrower. If I need to speak on a financial guarantee, which is nothing but a financial liability to be recognized in the financial books of an entity. Financial guarantee needs to be recognized initially at fair value. Standard requires the subsequent measurement of a financial liability as higher of loss allowance and amortized value. What do we mean by loss allowance? Loss allowance is nothing but the expected credit loss from the financial guarantee, which is based on the borrower's credit parameters. If there is no significant increase in the credit risk, an entity calculates the loss allowance based on 12 months expected losses of a borrower. The measurement of the financial guarantee is nothing but the cash outflow of an entity under the financial guarantee contract term to the holder of the guarantee and the amount it expects to receive on the contractual terms from the borrower. It is important for us to understand at what maximum period an entity needs to calculate the expected losses. Standard provides that it has to be a contractual term. However, for a recurring facility such as credit card or an overdraft facility where there are no technical contractual term and lender can withdraw such facility by just giving 1 day notice, it is important to understand how to calculate the ECL over which period. The basic understanding or the basic rule of calculation of the expected losses on such a recurring facility is a period over which the lender is in practice and exposed to credit risk. To summarize this webcast, I would request entity to assess what information is available to them, what additional information they need to extract, implementation of the new system and processes to smoothly transition to new expected credit loss model. Thank you. Tune into video.in, our website, for more illustrative examples on expected credit loss model.